There are two kinds of investors in the world, and how you put your founder investment theory together is going to be geared towards one or the other. We are going to talk about investors who are interested in primarily cash flow and talk about investors who are primarily interested in appreciation. One of the components of your founder investment theory, that theory of yours that you're putting behind your investments and portraying it as a story to your investors or your potential investors, one of those components is how it's suitable for them. See, there are different kinds of investors out there. There are investors who are really primarily interested in cash flow, and you have investors that are primarily interested in appreciation. So let's talk about cash flow investors first. Now, cash flow investors, as the name implies, are those investors who are really interested in a monthly or quarterly check in the mail, mailbox money as it were. They tend to be a group that either is relying on that income to be coming in at a regular interval, or they're relying on it because they plan on siphoning it off to other investments over a period of time. So they're going to be taking this pool of money and then just keep compounding it into other investments rather than your specific investment, right? So they may be getting that check in the mail, depositing it, and then putting it towards this other syndication or this other stock or this bond or whatever it is. So those tend to be your cash flow investors. Now, in general, and this is extremely broad, so don't take it with a grain of salt, and it's also not investment advice for anybody who is listening to this video who is looking for investment advice. This isn't investment advice. So that cash flow investor tends to be your retired person because they don't have a steady income coming in. So they are relying on that cash flow that's coming in. Now, the other kind of investor that is out there is the investor who is primarily looking for appreciation. So they don't want to check. Now, you may ask yourself, why don't they want to check every month or every quarter? Well, the big reason is taxes. So they will be people who probably have a good paycheck and get paid regularly and aren't relying on your investment for that that regular payment. What they are looking for is sort of like someplace to just keep putting money away where that will just grow for them, and then they don't have to pay taxes on it while it's in the investment. So a good example is a team of doctors goes and invests into an office building, and then they aren't really looking for any kind of appreciation whatsoever. They're looking just for, okay, in the end of 15 years or whatever period, we're going to sell this property and we're going to enjoy all the profits of it. Now, they are two totally separate tracks. I fall into the appreciation track. I make good money. I have a regular, I earn regularly. I don't need to be paying taxes on a yearly thing. I'd much rather be putting that money away and watch it grow, right? And watch it have a transaction that turns into a sale, and then suddenly now I've got a nice bit of appreciation. So I'm not paying at that regular tax rate. I'm paying at that capital gains rate, not the annual rate, which is much higher. So that is a basic picture of what those two different types are. Now, there certainly is people, and a large number of people, who want both, and they exist and they're out there. The point of this video really is not to say one or the other, or that your deal should be one or the other, because they're all different. Every deal is unique. It has its unique fingerprints. But what is critical for you to do is to identify what kind of investment it is, because depending on what it is, it's going to change how you talk to your investors. If it's a cash flowing investment, you need to have that conversation with them, or they're going to turn off instantly if they're an appreciation person. And maybe that's okay, because if all they're looking for is just appreciation, a cash flow deal probably isn't right for them. Or vice versa for the appreciation person, but the person who really needs the regular money coming in. My name is Tilden Moschetti. I am a syndication attorney with the Moschetti Syndication Law Group. Now, what we do is we help real estate syndicators, developers, private equity funds, businesses raise capital, raise that money that they need in order to put it into their business, put it into their syndication, whatever it is they're raising money for, not only for the benefit of their investors, but also for the benefit of themselves. They make money this way. So we help make that whole process legal and compliant under the SEC rules. Now, if we can help you stay compliant under Rules 506B or Rule 506C of Regulation D, love to talk with you. Give us a call. Our link is at the bottom of these notes.